Welcome to Stock Market Investing with the ARMR Report. I'm Brent Rosenthal, and I created the ARMR Report for you, the individual investor deciding to manage his or her own capital. I wanted to bring you guys together with the flow of actionable information, right? So we want to cut through all the noise and just share information that helps us improve our P&L experience. Now, what we like to say on the trading desk here is that information makes money and institutions make markets. And to that end, we're going to talk tonight about gamma information. Gamma information makes money, and institutions have been using that information for years. So it's time for you, the individual investor, to understand that information flow and see how it applies to your process. And so we have the pleasure of the founder of Spot Gamma, the information source that we use at the ARMR Report for all of our gamma needs. Brent Kochuba is going to join us tonight and take us through step-by-steps how to use the information and apply it to our process. So the ARMR Report, for those of you who are new here, is a personal approach I use to manage capital. I've been doing it for about 35 years. It's a three-step process. We build our whiteboard, that's fundamental research. We use ARMR algorithms to help us know when to execute, add positions, subtract positions, put on risk, take it off. And we marry that with a stop-loss discipline. Those three stages is the process I use to manage my own capital. So, as always, the information we're sharing tonight is not to tell you what to do. We don't know your risk tolerance. We wouldn't tell you what stocks to buy. But we can share our information source. And over time, you can apply it to your own process. And we hope this will enhance your P&L over time. That's the idea tonight. So without further ado, let's say hello to Brent. Brent, thanks for joining us tonight.
Hey, Brett, how you doing? Good to talk to you.
I'm doing well. I really appreciate you spending some time with all of us at the ARMR Report.
Absolutely. Try to center myself there a little bit.
Excellent.
There we go.
So,
shift in the frame.
Brent, here's the thing that I find about a lot of these type of shows on YouTube or wherever. People spend a lot of time talking about information that doesn't actually make them money, right? They go on and on about this, that, and the other thing. So tonight, what I try to do on this show all the time is cut through all that. I want to ask everybody watching tonight to accept the fact that gamma information can make you money if you understand how to use it. So when it comes to Gamma 101, there are many great sources you all can go find. And in fact, there's many sources on Spot Gamma's website that break down what gamma is, how to use it. What I'd like to do tonight with you, if you will, is take the source, take what you're sharing with us and apply it to our process at the ARMR Report. But from a bigger picture, individuals can apply this information to whatever their trigger source is to get involved in a transaction to enhance their probability of success. That's what we're really trying to do.
That's right.
I like to say that, you know, my job at the ARMR Report is to get on the right side of probabilities over and over again when rewards worth the risk.
That's right.
And gamma information, I discovered when I started using your source a few months ago, gamma information to me seems to increase the reward part of that picture.
Yeah.
You know, the risk part is, for me, a stop loss. So I always know when ARMR Insiders, subscribers, when we're putting positions into a portfolio, we already know what our stop is. We know what the loss is. We move on. We go to the next idea. So the real question I think to get at is, what are the biggest reward opportunities? And that's how I think gamma helps. But before we dive in, would you just give us a quick background of yourself and how'd you start using gamma and how'd you decide to start Spot Gamma, which is such a gift, I think, for individuals?
Sure. And, you know, one thing I want to say that just ticked through my mind is you mentioned your stop loss and the discipline there. And I remember when I just started at a bank, and we had a big fund come in, you know, a fund that everyone knows, come in and give a talk. And they said that they didn't pick winners any better than anybody else, but their discipline to cut their losers fast was where all their success was. And so you saying that, stop losses is a key part of your methodology it sounds obvious to everybody, but not a lot of people have that discipline to stick to that. So that's an aside, but it came to my mind.
Well, I appreciate that.
Yeah. So at any rate, I worked at a few different banks. I've been in a professional options position, a derivatives position for a little over 15 years now. Like I said, banks, and then I worked at an options market maker called Wolverine Trading. I was on the broker dealer side of that, so I was not a market maker there. Then I worked at a family office, and I was doing some options modeling there and trying to build options-based strategies. And what came out of those models was what started Spot Gamma ultimately. And so what I was able to find was that there was a lot of information in the options market and in where things are trading in the options space, and how dealers would hedge and all those types of things. And I found great value there. And what I also found was sort of unique to what you're saying is that in and of itself, the options data is not necessarily a strategy, right? It's giving you key levels. It's giving you key pieces of information. I can tell you, how much volatility there may be tomorrow or next day, or what my idea of that is, or what my edge or probability is there. But you really need to have a trading or an investing framework for which you kind of apply this over. So really that's what the models were built to help, is to facilitate everyone with their own strategy, right? To explain some of the things that are happening in the market. And so a lot of that, rings true with what you just said.
Yeah, that's how I felt the benefit of Spot Gamma the most. To me, it's like a turbocharger on an engine. You got to have your own engine, and then you put this on top, and it's like real eye-opening, for us. But I do like to say all the time when I have these conversations on YouTube, a lot of people carnival bark and they talk about buy these 5 stocks, they'll go up tomorrow. That's not what this show is about. This is about protecting capital first and then capturing upside, right? So it's putting all this together and protecting your capital that gets you where you want to go from a P&L standpoint is at least what I've discovered over time, and I'm trying to share.
Yeah.
So
yeah. I would say too, from where I started the business, officially, really only about a little over a year ago. The market has changed so much. GameStop, the hearings today being, just sort of the culmination of, I think, a lot of that. In that option flows, we were talking before about how you couldn't necessarily run a strategy off of option flows, and now we see, just interestingly, that people are trying to use options to force stocks to move, which is not something you can really do in the S&P, right? Because you the capital is you just need an absurd amount of capital to do that. But in some of these small cap stocks, you see it showing up, which is interesting, and just something that came to mind that I wanted to mention.
God, I got so many questions for you, and I could go down a rabbit hole in that conversation. Yeah. I'd love to, but let me maybe we'll get back to that, because my one question that comes to my mind is, how long can that persist before that gets shut down? Because it's really bastardizing the market to a certain degree, and that kind of concerns me. But let's just do, for the sake of this conversation right now, I want to get everyone acclimated to what we're doing and show them how we use. I'm just going to walk you through a basic process that we do every morning. So at the ARMR Report, we do a live screen share of how we trade first couple hours of the day to day trade. And so literally the first thing we do, and I'm going to show this chart right now. This is a chart of a 3-minute graph, just for those of you who are new to this. Every bar is 3 minutes. The blue bars are up bars, red bars are down bars. All these different lines, with the exception of these purple dashed lines, is an ARMR Report algorithm that we use centered around this black dots here, which are the volume weighted average price, right? So to us, VWAP is the most important, source of information for making our day trades. And we use standard deviations above and below the VWAP. We do mean reversion trading, things like that. Mm-hmm. And so, but what we do when we first come in, in the morning, you share this information with us. And I'm just going to show you all this screen here. So this is like, this morning's call from Spot Gamma. and you write this really interesting note that helps us get our head straight on, where the market is perhaps going. And then if you scroll down here, you give us these levels on the S&P, right? And so what we do is we just take these levels, and I'm using TradeStation, so I have to manually put this in, but we take these levels and we overlay them on our own chart, right? And then we have our own process for how we look to put positions on. And so this morning, you all could see right down here what we look for. And I just call this, just real quick, Brent, I call it a crazy Ivan. Okay, to me, if you've seen the movie The Hunt for Red October, you familiar with that?
Yeah.
Okay, so in The Hunt for Red October, there's this discussion about how the Russian submarine driver will all of a sudden, for no reason, turn the submarine around 360 to see who's behind him. And I feel that's what the stock market does all the time in this, what I call mechanical bull market we've been in for years now. So for no apparent reason, it just reverses and implodes. And then it seems to stop on a dime and go the other way. And so often it stops on a spot gamma dime. And so again, when I say stop on a dime, it doesn't have to literally touch this gamma level, right? I mean, everybody has to understand we're looking for behavior near or around prices, right? So this morning it gaps down. This is prior day's pricing, right? And here's the line of demarcation that starts this morning's gap down. And it gaps right to the levels that you tell us, right? You say, hey, here are some key gamma levels. It breaks below it and then finds support right here, puts in a double bottom and rips higher the rest of the day. So one question I had for you, if we can just talk like this for a minute. And actually, let me share this with everybody and ask this question. Could you walk us through real quick the different gamma levels here? So I get the call wall and I get the put wall. Okay, to me, that's a no-brainer. If it goes above call wall or it gets to the call wall, that seems like the real brackets. But which do you think are most important, or are all the lines important? Could you just walk us through that a bit?
Sure. So there's a few different ways that you can look at this, right? And if you don't understand gamma or the basis behind these numbers, I don't think you actually need to know anything about the options market, right? The first thing is these are all support and resistance levels. And what the labels are telling you is where different positions are concentrated. And so what we basically have is we have large areas of puts and large areas of calls. And then there's kind of a happy medium where there's a whole bunch of calls and puts that overline or that both show up at the same strike, right? So you can think of it as a lot of calls show where people are very bullish. A lot of puts show where people are very bearish, and then then there's the middle. So if like a bell curve, that's kind of what we more or less end up with when we talk about where options are positioned. And so as you can see on that chart there, we have this blue line, right, which is the area chart, which kind of cuts at an angle right through the whole graph, and that's essentially telling us how much hedging firepower dealers have, how much hedging firepower market makers have. So the higher the number is, kind of where your cursor is, that's telling us that in that area, market makers have a whole lot of hedging to do. And their hedging activity is the type of activity that suppresses volatility. And so what I mean by that is they're going to be buying dips and selling rips. So if you think about the dip today, we came into the market with a very high positive gamma level, high positive gamma number. And so the first thing you could think about is, okay, that means that there's a lot of mean reverting firepower in the market, right? That means that if a dip happens, the edge has got to be towards mean reversion because market makers have to buy back stock, right? They have to buy back some hedges there. So that's kind of the basis where you start. And that's key to...
Wait. Let me ask you, just so I understand. So you're saying on days where we're close to the top of this blue line here, there's more mean reversion trading that goes on?
Yeah, so anytime you have a positive gamma, so if you see the black line there is the underlying last price of spiders. That's where the price is at spiders when we last ran the report. And so you can see that black line crosses the intersection of that gamma line, which is the angled line there, above zero, right, on the y-axis, meaning that we're in a positive gamma environment, which means that market makers have this mean reverting firepower, right? This means that they'll be and I don't want to cover sort of gamma too in depth here, but basically when dealers have positive gamma position, they're going to buy the market when it drops and they sell the market when it goes up. And so you can see how that compresses the daily trading range. And that's why we say it suppresses volatility, right? They're preventing breakouts, but they're also preventing drops in the market.
So that's key, everybody. Get your pen and piece of paper and write that down. What you just said is important. Say, when you're in that positive gamma area, you can look for that mean reversion. And so this is why this morning, when we were talking at the ARMR trading desk, we were sharing information and we saw that rip down, that crazy Ivan, as I call it. We're not looking for the market to implode. It's just it's a move back to take a look at what's down there before it rips back up towards that mean. But you're saying if we were in negative gamma, we should be more concerned about something that looks like let's say a crazy Ivan turning into a real sell-off that implodes. Is that what you're saying?
Yeah, exactly. So what happens when dealers have a negative gamma position, and this goes for not just dealers, if you sell an option, right, you fundamentally have to hedge that differently. So when we say that there's a negative gamma market, so on your chart, that's where that blue line crosses the zero mark to the left, right? So that strikes below where we're currently trading now, right? And that's where this sort of, you can see that on your chart there where zero gamma and both the vol trigger, and I'll explain the difference. But basically where you see zero gamma is the mark where we see the market where dealers are suddenly shifting from a mean reverting type flow to selling with the market. So the way that you hedge in a negative gamma environment, when market makers would hedge in a negative gamma environment, is to trade with the market. If the market starts to sell off, they will start to sell futures. If the market starts to come back, they will start buying futures with that rally. And so inevitably what happens though is that first move, the initial move is the market is going to sell off for us to get below zero gamma line. So that means that the initial move almost always has to be dealers shorting as we cross that, in this case, 388 price level, which is the gold, yellow kind of bar in your chart. So when you're coming in the trading day, right, you're thinking if it's a mean reverting day, right, and the higher, what we say is the more positive gamma there is, and this is a metric we tell everybody every day, how much notional gamma is in the market. If we have, let's say, 1.5 billion on your chart there as on the y-axis of positive gamma, we expect a very tight trading range, very, exhibits strong mean reverting behavior, right? And then as the gamma starts to wear down towards zero, we think the mean reversion has a little bit less power. And then if we get to a negative gamma situation, we're not playing mean reverting anymore. We're looking for big swings. And
so this is a very important piece of information to me. And this is one thing I wanted to get at tonight, because, there's a big move between 388 and 380, right? And so we all get into this, again, like what I call it, the crazy Ivan. I love to trade the crazy Ivan. I love to get that initial sell-off, or at some point during the day, there'll be an hour and a half sell-off that comes right down to a gamma level, reverses. That's where we put all of our day trades on, and it rips higher, the rest of the day. But what you don't want to do is get caught in that, where you're putting all this capital to work and it breaks what level before we have to say, wait a minute, this isn't right. And it sounds like you're saying if we go below zero gamma, we have to be very concerned about that buy the dip trade that everybody tries to do.
Exactly. And what I found where it is also helpful is that, like this morning, for instance, you can take the temperature of traders and you can kind of see what's going on. And there's a lot of people saying, this is the big one, this morning. And, your edge against one of those big moves happening is generally pretty small, right? Just in any random market day to get a 2-3% sell-off, it's a lower probability event in the first place, right? And so if you can frame your trading day and you could take your levels that you guys use every day and say, okay, these are my key levels, right, Brett, that you set up on your chart, and you have these very interesting VWAP algorithms and your bands and things like that. And you see the intersection of what you're looking at along with this gamma mean reversion or negative gamma directional trading. You can combine those two, and I think it makes it much more successful strategy, because fundamentally that there's a very big player that's on the same side as you, right? And that's really what market makers are. If you think about an options market maker, they're different in their flows because they're hedging and rehedging all day long. So they essentially have, in a way, unlimited firepower, right? It's not like a big fund who's going to put on one trade and then be done for the day. When the market goes up another 1%, dealers have to sell. When it goes down 1%, they have to buy. They keep doing this all day long, right? And that's what makes them such a powerful force in the market. They may, they're not like Warren Buffett where they go buy 1 million shares and sit on it for 10 years, right? They're trading all day long, in and out.
Well, so let me ask you this then. This was one of my key questions. I tend to, when we get to a call wall or we get to a put wall, my initial thought is I want to short the call wall and go long the put wall. I'm not talking about it right now in this scenario. I'm just saying, in fact, let's just talk, the two of us, for a second. I'm just saying, I could be, we look at the market, it drops to a put wall. I look for my own personal engine, right? Our ARMR engine tells us, okay, here's a reversal. Let's get long for the rip higher. What, if anything, in your information that you provide every day would tell us when to pause at that idea? In other words, you better not be adding here at put wall. It might plummet through it, or you might not want to short the call wall. It's going to blow out above it. Is there any information that you're sharing every day that would say to us, wait a minute, the probabilities of success of that reversion trade is,
Yeah. So I get your flavor there. So with any model, right, the call wall is simply telling us the strike that has the largest net call position. So that's telling us where sort of the max of where investors think the market's going to go up. And so you can think about that in two levels, right? We could have a call wall that has 1 million contracts at it, or we can have a call wall that only has 1,000 contracts at it, and it's still the biggest level, right? So there's sizing to all of this stuff. The model just knows which one's the bigger one is, the biggest level is of call wall, right? But we still have to figure out, is there actually like a ton of options there? Or is it just sort of like, is this a weird market where there's very small positions, but the call wall, the largest strike is still the largest strike. It just may not be in the context of, historical level is a huge one, right?
Well, I get it, but I'm just talking about the indexes right now. I'm going to share with everybody in a minute, individual stock gamma information you share with us.
Yeah, right. So this is what I'm referring to, like in the SPX, right? So for example, the call wall today is 4,000 is that strike, right? But in spiders, which is linked very closely to SPX, as you know, the big wall is at 395. So you have to sort of analyze that data, those two data points, to figure out, okay, what are we really trying to figure out here? Is spiders bigger? Is the spider enough to hold the whole S&P down? Or is the fact that, spiders has a smaller notional value maybe at that strike than the 4,000 strike, is that telling us that the market could really shift up to 4,000? So that's just kind of an example of, the size of the actual level is important. So in other words, my model just says, okay, this is the strike, 4,000 with the largest net call position. But does that mean that there's just 1,000 calls there and it's the biggest, or is there 1 million calls there and it's the biggest level? So what is the size of that, right? What is the significance of that level? There's times where we've seen $2, $3, $4 billion of total positive gamma in the market. Right now, we only see around $1 billion of positive gamma in the market, right? So the metrics are changing and shifting, and how those metrics change and shift is also important information, right? Okay. I'll just give you an anecdotal, evidence of that. If you think about the call wall is telling you where the most calls are concentrated. Net calls are in the S&P, right?
Right.
If that level goes from 3,900 to 390, 3,950, that's giving you information, right? That's telling you that more investors have just added calls up at 3,950, right? Yeah. If they suddenly shift again to 4,000, that's telling you more information. That's telling you that call buyers and call sellers, they're all stepping up, right? They're pricing the market moving in a different range.
Okay.
So if the market were to breach, let's say the call wall is 3,900 today, is 4,000. Let's just say for sake of argument, it's 3,900. If tomorrow more calls didn't build overhead, that's telling you information, right? That's telling you that people don't see activity taking place above this level, right? So there's a behavior element to this in a way.
Okay. All right. Let's get back to my question a minute ago about, you've explained zero gamma to us. We know the call wall and the put wall, what that means. What about the volume trigger and absolute gamma? Can you do you weigh those lines as important as these the call wall or zero gamma, or do you weigh them less, or is everything the same to you?
Sure. So I'll start with this, what we call the absolute gamma. And we call it absolute gamma because what that is telling you is where the most total call and put options are. And this is all of a gamma weighted basis. So let me kind of pause right here and just talk about gamma and why I measure everything in gamma.
Okay.
If you think about open interest in general, and many of you are probably familiar with put and call ratios, right? If you were to look at the put and call ratio of the S&P 500, it's going to include options that are down at like the 1,000 strike and all the way up to the 10,000 strike in the S&P, right? Those options that are at 10,000 and 1,000 are basically completely irrelevant to whatever hedging activity is taking place today, right? Now, gamma is a Greek measurement. And I know most of you in this room have done some studying on this, but gamma is highest for at-the-money options. Gamma is also the most important hedging flow. It tells you where the most hedging flow is located, right? So when you think about gamma, you just say, okay, he's telling us that's where all the options hedging flow is tied to. High gamma means high hedging flows. So the absolute gamma strike is where, on a gamma weighted basis, the most calls and puts sit. So think of that as a big fat magnet, right? And if the market goes over 3,900, there's going to be flows that are going to pull it back down to 3,900. And if it goes under 3,900, we have this mean reverting flows that shift the market back up.
Oh, okay. So you're basically saying that every one of those lines you offer are important lines for us to pay attention to. There's no skipping over something. They're all important.
Right. And some of it is contextual, right? Like the call wall today was not going to be in play really at all. Now, if the market happened to go up, rally, then it would come in play. But in general, you have to look at where the market's trading and figure out. I mean, here it looks like all these levels are, quite concentrated, but we produce a number every day that tells you what we think the daily trading range is going to be. And as you know, with your VWAP bands and things like that, the market changes every day, and sort of what you think the limits are in terms of price, change, right? No one was looking for a 1% rally probably today at, when the market opened very weak. Right. So it's another way of saying that even though it looks like there's a lot of levels sitting here, on any given day, there's probably only maybe one or two levels that really come into play.
All right. Let's move on real quick. I mean, I've got so many questions. I could talk for hours, but let's move on to individual stocks. I'm going to click on this screen you have here, which is your equity hub. And so we put in the symbol. And again, I'm going to ask everybody who's watching this to go to Spot Gamma's website. You can click on the instructional videos. You'll understand more of this if it's a little over your head right now. But let's just focus. I want to ask some key questions on what this information tells us. So right now we're looking at Levi's. Yep. I'm going to fire some questions at you because these questions have been on my mind for so long. I just want to fire questions at you and see where it takes us. So if we look at Levi, you put this comment up here, 60% of gamma is expiring Friday. Okay. The stock could reverse after expiration, resistance at 22.
Yep.
So when you say reverse after expiration, resistance, does that mean you think it's going down? Are you making a comment on direction? Or if it's gone down, you think it would go up? That's one question I have for you.
Sure. So that's obviously written by an algorithm, and what the algorithm is looking at. We talked about gamma and why it's important. So we're looking at this chart of Levi, and all of the strikes, the biggest and most important option strikes, all line up right at 22. I have absolutely no idea what the stock did today, so I'm going to say that as a preference. But when we see two things, right? So gamma we talked about as being a very important hedging target, right? A pin level for options. And so when that gamma expires, the pin is essentially removed, right? The dealer flows that were attracted to the 60 price level, those are going to be reduced by 60%. And we know that because we can calculate how much gamma is tied to tomorrow's 4 p.m. expiration. So that 60% figure there that says 60% of the gamma is expiring, we know that essentially the strength of that pin, 60% of that strength of that pin is gone, right, on Friday night at 4 p.m. So that is important to understanding volatility, right? Generally with stocks, they're going to trade as we get closer to expiration. The hedging flows, people rolling and changing their positions are going to force the stock in general to go to this key gamma area, right? And then on Monday morning, when that pin is removed, right, because 60% of the options position expired, the pin, since that pin is gone, it can trade away. It can trade to a different strike level. So that's the first piece, right? The second piece, you ask, why would we think there's a reversal? When you have deep in the money options, that's implying that dealers have large hedges tied to those options positions, right? So let's think about this for a minute. If you, Brett, bought a call option from me and Levi, an 18 strike call, and the stock is now at 22, if I'm the market maker, I'm short that call at 18, and I probably own 100 shares of stock now as a hedge against that short call position, right? Because you bought it when the stock was at 18, and since the stock went up and I'm short the stock, I had to buy actual stock. I'm short the call. I actually had to buy the stock to hedge myself, right? So your position, again, Brett, is you buy a call at 18, you're long the call. I'm immediately short the call, and I have to buy stock as a market maker to hedge myself, right? Because I can't take directional risk. I'm not here to figure out if Levi's is going up or down. I just got to hedge. So, okay, so if the stock is at 22, our current position is you're long a call. Good for you. You're up $4. I'm short a call, but I'm also long 100 shares of stock, right? On Friday afternoon, you decide that, okay, this is great. My option is going to expire, and you close out your call position, okay? You're now flat. My call position has been closed, right? I was short a call. I'm now closed, but I still have 100 shares of stock. What do I need that stock for? I got to sell it. And how do I sell it? Well, I'm not here to figure out if I'm going to VWAP this thing or whatever. I'm just going to sell it. So imagine now that is done with thousands and tens of thousands and hundreds of thousands of calls that are all expiring tomorrow at 9:15. All right, excuse me, at 4:30, 4 o'clock p.m., sorry, Eastern. So you have these giant options positions that are all expiring. So the reason that we would say we look for a reversal in the stock is because if there's a bunch of in-the-money calls, dealers are long a ton of stock, all those calls expire, dealers got to sell stock. Now it works the other way. If everyone was long puts and the stock was going down, dealers would be shorting, dealers and market makers, I apologize. I use those terms synonymously.
We get it. We're with you.
Synonymously.
We're with you.
So if I'm short, if you bought a put in Levi, I'm short the put, I got a short stock to hedge myself, right? So the reverse happening. If a whole bunch of puts expire, I'm now going to have to buy back or release all my short stock, right? So that's what the reversal is.
Interesting. Okay. So that would suggest then that, let's say Monday morning, there should be pressure on Levi stock, all things being equal.
That's right. Now, some of this is where you as the trader and you as the investor need to understand the position in your stock. There's times where it's very easy to figure out which way people are leaning in a stock. Everybody knew which way people are leaning in GameStop. Everyone knew people were buying calls, right, in the beginning. Everyone knew that these pot stocks on Monday, everyone's buying those pot stocks, right? Now in Levi, I don't know anything about the stock. Do you know whether people are likely to be buying calls or buying puts, right? Do you have a good feeling? And I'm not putting you on the spot. I'm just saying, how do you know how people are positioned? And if you understand the stock and if you understand, the mechanics, then you are right. You would expect weakness on Monday. And so we found that there's a big correlation here between, the trading activity on Monday morning and the expiration on Monday night. And that goes for the big index products as well as these individual stocks. So, I don't know where Levi is trading today, but if it's around 22 tomorrow, and if I was looking for a trade long or short in that stock, I wouldn't touch the thing until maybe Friday night, saying, okay, the pin's going to be removed. Now I know I can get some price action and some price movement there.
Got it. I got it. That's it. That's very interesting. And so for an investor, how does somebody take this information as an investor who's using your service? An individual investor is getting this information. They find a stock they like. They get that information there. And the way I would interpret that is I would say, hey, if you were looking to buy the stock, you might want to wait till Monday, let the stock come down. It's coming down on Monday, and that selling that's happening Monday morning should be short-lived. It's not investors who are all of a sudden thinking there's something wrong with Levi. It's just dealers getting rid of their position, and whenever that's finished shaking out, there's your entry point. So that's a way for an investor to take on that information.
And there, you know, this is also an interesting thing, because even if you don't trade options at all, you've been forced to understand the options market because of everything that's been happening with options volumes, right? Think about a value investor in GameStop. If he sort of he or she ignored the options market and what was going on there over the last several, weeks, they would be doing themselves a grave disservice, right? So let's talk about, like, if you were interested in buying Levi stock, let's say that Levi traded up to 24, and I have no idea what happened to stock.
It's a little under 22 right now. It closed at 21 and change. Yeah.
So let's just say I was interested in, or let's say I own Levi stock, right? A big position, and the stock for some reason traded up to 24 this week, and there was really big call volume. If that key gamma strike remained down at 22, and the most of that position is going to expire on tomorrow night, right? I would start to be worried about that stock starting to come down. And that's because of that gamma pinning effect. So I'll illustrate that for you here. Let's say that at the beginning of this week, on Monday, you bought a Levi 22 strike call and you paid $22, or sorry, you paid $2 for it, right? If the stock doesn't go up at all, if the stock stays at 22, every day your call option is going to lose some value, right? Because it expires on Friday, there's time decay there. So it's going to every day lose some value. Every day that option loses value, as a market maker on the other side, let's say on Monday, you buy the option for $2. I'm short the call and I hedged long 100 shares of stock. Every day your call option loses value. So let's say on Tuesday, it's worth 80 cents. I can therefore sell 20 of my shares. And let's say the next day you lose another 20 cents. I can sell another 20 of my shares. So that by Monday, the stock has had all this pressure because of call decay and position decay that pushes the stock back down to that big gamma area. And there's also this other behavioral aspect to it, right? If that gamma area, that big gamma strike of 22 never shifts up, that's telling you that call buyers aren't wanting to roll higher, right? There's no more call positions at higher strikes. It's telling you that, like, options buyers don't believe in this. They don't believe in that move higher. So maybe as an investor then in Levi, I want to trim some and look to buy back at the 22 level, right? Thinking that it could come in. Or maybe I want to sell a call against my position because the stock maybe has gotten too extended on an options, when you analyze it from sort of the spot gamma perspective.
I get it. Let me share with you a chart here of CHWY from the other day. So here's a chart of CHWY, okay? And this is a trade we put on our trading desk, and it was a big success. So right here was the VWAP from the previous day. The stock closed right at VWAP. And at the time, what your information was sharing with us is that right here at 110 was the key gamma level on CHWY. Mm-hmm. And so the way we trade on our desk, this is our own engine, right? When an asset trades above prior day VWAP and then goes above top day VWAP, which is this bar right here, if it's also breaching the gamma level, we can get explosive moves higher, which is exactly what happened in CHWY. What I'll tell you what's interesting. If you look at this chart, and then we shrink it down now and fast forward, because this is the 12th. So if we shrink it down and fast forward, look where it ended today, right back down to that gamma level.
Yeah, so, that's kind of this is exactly what we were just kind of talking about, and it's funny.
Yeah, that's what. First of all, that's the power of gamma information. Now, overlaying that on top of your own trading strategy, whatever the individual investor, whatever you guys are using as your trigger, understanding where the gamma is, and then what do you think happened right there on this day? Is that just everybody got trapped? Is that the right way to look at that?
I think so. There's a couple of ways that I would look at that chart, right? One, gamma being a support or resistance line, is a big one. So you found that a breakout, and I would look and say, well, you have support at that level on Monday morning when you bought it. So that would be my initial framework, right? Because I believe that dealer hedging flows are going to be supportive of the price at that level. So if I want to get long, I would feel okay because I feel like the stock couldn't come down much below that gamma strike being a pin. Now, in CHWY, what gamma is officially telling you, right, is that there are a lot of.
That's a good wait. Hold on a second. That's a great point, though, because that's also what the stop is going to be for us, right? So once it pops above that gamma level, you have a tight stop. If this thing reverses back below it, you exit the position and look for something else.
Yeah.
Correct.
Yeah, that's right. So what happens oftentimes on a lot of these names, and I'm not sure what Chewy's options flow look like is, but you'll see call buyers come in with very short-term views, right? And what I mean by that is they'll typically buy the next available expiration position. So they'll trade out in, this Friday or something like that, and they're trying to juice the stock. And so anytime that a new trader comes out and buys a call, a dealer has to do what's called a delta hedge. And the delta hedge is when you buy, let's say, one call, if that call has a 50 delta, I as a market maker have to buy 50 shares of stock. And I have to do that right away. So if a bunch of people do that, then in succession, right, rapid trading, news breaks or something, then that market makers just had to buy a bunch of stock to get themselves hedged. And then as the stock goes higher, they have to keep buying more stock, right? That's the gamma piece of it, the hedge adjustment. And so what I would guess would happen is maybe you get news, maybe you got some other piece of information, but you get the ball rolling and you get market makers moving the same way as you. And this is giving you the information that you have a big tailwind, right? So that's a beautiful trade, the CHWY trade, on my view, because you buy it right at what I view as huge support. And then it happens to be that, call volume went your way or whatever it may be,
Right.
or just news, there can be a variety of reasons that stock jumps.
I want to move right into that question for a minute because I want to share with everybody what you guys call your scanner, because I want to ask you, how can we use your spot gamma information to look? One of the hardest things for day traders, investors, you might have 50 stocks you're watching. Okay, how do you figure out the 5 or 10 you want to trade each day? So what we're doing on our desk is, we're constantly looking at all of our favorite names, looking for the gamma location and seeing if we get, our chart trigger, right? The ARMR Investing Way, if you will, which is to use a VWAP and to have it sync up with the gamma location. We're looking for those all day long. So in a second, I want to flip over to your scanner. I wonder if on that scanner is a way to help us focus our attention. But before I get there, you got these red, you got the red over here, you got the green over here. Is there any quick and simple way to explain to us? I know you have a good video on your website that explains all this, but I've seen some of these charts where the whole thing is red.
Yeah.
And the stock's going up anyway. Or should I be avoiding that stock because it's all red? Or
depends on whether you want to buy or sell.
What?
So the red and green tell you simply whether the name is currently in control or embedded in a put gamma position or a call gamma position. So the fact that CHWY is in this big red area is telling you that it's surrounded by put positions. And so the way the stock could trade would be different. Meaning, if you know that people are long puts, right? The chance that the stock could sell off hard and keep going because of dealer hedging activity is higher than if we were in a green call gamma position, right? Because you think about the direction that people need to hedge. So if you look at that chart too, you'll notice that the red area to the left, down around 85, that the y-axis goes up. This is a way of saying how much dealer activity could impact the stock. So the fact that spikes up around 85 is telling us that somewhere in the 90 area, there's probably a lot of put positions there, right? And those big put positions will push dealers to have to sell a whole bunch more stock. So if the stock was to start to sell off underneath sort of, the 105 area in particular, I would not be trying to buy that stock, right? I would be sitting back and saying this thing has fuel to the downside, right? Because the red area is telling me it's a lot of put positions, and that fact that y-axis goes up tells me that dealers are going to have to keep shorting the stock when it goes lower. So if we go over 115, suddenly then you have a lot of call positions, right? And the call positions are wind at my back for betting that the stock is going to go higher.
So is that one way to narrow our list of 50 names? Is it that simple to say, let's only try to focus on the names that are at or in the green?
Yeah, I mean if you guys are typically looking for stocks to buy, then that's a good one. The other interesting one harkens back to this original discussion about the reversals, right? There's a lot of names I've seen where there's big put positions, and when those big put positions expire, dealers, as we talked about before, can suddenly buy back their short stock hedges. So we have a great example of that in like Intel and a few others on the blog, but you could just understand that put positions, if there's a bunch of long puts, right, there's dealers who are shorting stock, right? And when those puts go away, the dealers don't have to short stock anymore. So suddenly you have like this burden, right, that's lifted off the stock in some ways. And the other thing to note on this is that how dark the color is tells you how big the option position is. So the darker the color means there's a bigger option position. So when you just glance at this, if it's a very light shade of red or green, that there's not really a big options position, and options probably don't affect this much, right? But in like Intel, there's always a big, options position there.
I got it. I just wanted to see if this is still massive red. I'm just curious. Yeah, see, so what does something like that mean to you? So there's no green at all on the screen on Infinera. So that's a stock. Yeah. We should not be long this stock if we're looking to be long. We should be, because we're just fighting. We're a salmon going upstream.
Yeah. So right. So if I was gonna maybe want to get long this stock, I would look at Friday night or Monday morning if the stock was around 10, right? And that's simply because 40% of this position expires on Friday. So that could be the sign that this thing could really turn around, right? If the stock has been constantly pressured, maybe then is where we kind of get the lift off, because there could be a big dealer short position that needs to be, unwound. So if you scroll up a little bit there, you can see where the top put OI is, right? The top put OI is actually not until the 5 strike. So that's telling you where most of the puts in the name are.
Okay.
And then the other thing to note here is that we have the next expiration delta. See that? It's 2 columns to the right. So that's telling you that at the next expiration, which is tomorrow, only 10% of that big 5 strike put position is going away. That's not all that big, right? So in terms of that delta buyback for tomorrow, that's not actually that big of a position. But
you want to see a big delta buyback on Friday for stocks.
If a big delta position is expiring and that's a very red picture, then that's the chance. Like, okay, now this thing could get a real pop. So you can see on the top delta expiration column, 2 more to the right, there's a date there, right?
July 16th, 2021.
Yeah, so July 16th is when that big put position expires. So in terms of looking for a reversal based on what we were just talking about, the dealer expiration, that would be a date I would highlight. Now, oftentimes in names, that delta expiration is this week or next week. It's something, closer. But looking for that put buyback sort of flow, I would look for a delta expiration that's
this is invaluable. This conversation with you is invaluable, man. That's brilliant, because this is take our list of 50 or so stocks and narrow it down to the few we want to trade each day. This is and
if you scroll to the bottom too, there's a history tab there, and so this is also interesting because we were talking about before about watching how strikes are moving around. Now 10 has been the same strike in this name for the last 5 days, right? We were talking about CHWY and how it moved higher. If that gamma level is moving up or moving down, that's telling you where the bulk of options positions are going, right? And so that's giving you information. If that goes up and then goes down, you're it looks like if it went from 115 to 110, that means a whole bunch of either put buyers came in or people sold calls and the major strike in the name shifted lower. That's bearish information, right? That gamma strike goes lower.
And so this is going from 115 to 110 to 105. So that's real bearish.
Yeah, right. And then, and then on Monday, I think a good portion of this position sort of shifts. But you can just tell, like, just behaviorally, look at that top call open interest line, right? If that doesn't shift higher and the stock is going higher, well, why don't call buyers want to keep buying this thing, right? Why are call buyers backing away? That's telling me that I'm losing my tailwind here. And again,
this is precisely this. You just explained why we caught a big day. That was great. It was a day trade. It came all the way back down to that price.
Right.
It was not an investing opportunity because of the pull back to that price.
Exactly. And so in that top gamma expiration, they're never changed, right? It's all 219. I believe it is. I can't see perfectly there, which is 2 more to the right, that date. So that this Friday was always the big expiration date in CHWY. And so if those levels were shifting, but the top gamma expiration was, say, March 19th, right? That's telling you that that the market is not quite as sensitive to the options position because it's farther out in time. So the closer the expiration date is of that top gamma, the more sensitive the name could be, and the more you want it to be a day trade as opposed to I'll hold this for a few days.
Perfect. Look, there's so much information to reveal in these conversations that I literally could talk to you all night. But I have promised ARMR Insiders they'll get their shot to ask you some questions. They're going to fill up the chat room, the Slack room that we're in. They're going to ask some questions. So while they're filling that up right now, guys, go ahead, ARMR Insiders, go ahead and fill up any questions you might have in the Slack room right now.
Let's take a look at GameStop because that's what everyone likes to talk about. It's kind of fun.
That's true. I want to. But, okay, before we go, we'll look at that. I just wanted to share the scanner real quick and see if you got any thoughts.
Sure, yeah.
But if you want to look at GameStop and talk about it, we can.
Yeah, so GameStop has been fascinating because for the month of February, it's hit options price levels to the T, and this strike. So if you show that the history tab there. There's so much action in this name and so many different forces, right, that have been involved. And it has pinned the key gamma strike basically every day, this week. First it was 60, and then you'd see that key gamma strike go to 50 and the stock dropped, and now it goes to 40, 45, and the stock drops more. And you've just seen these pin levels drop and drop and drop. And if you look at the put volume there versus call volume, call total versus put total. So all the way to the left, there's call total and put total.
Right here.
Yeah, so that's the intraday volume, right? And that's put dominated. And then the open interest is on the first, is all the way to the left. I just want to show the size difference in put open interest. It's the third column in from the left.
Oh, right here.
There you go. Call total and put total. So that's the total open interest in the name, right? So total put open interest right now is, what is that, 1.6 or 1.8 million contracts versus only 400,000 calls. Anyone hoping for a bounce in this stock, it needs, the second coming basically to help them out here, because, the weight of all that put volume is just leaning on this thing with full force. And that bright red chart is telling you that, and that gamma strike keeps shifting lower every day. And so tomorrow, 45% of the gamma position expires, and we think that probably removes some more support, and the thing just kind of keeps pulling back down. I mean, this is as bearish a chart as you can get, from my seat.
I've got you. I mean, how much time do we have with you left? Are you hard at 5:30? You're splitting, or?
Yeah, we can take another 10 minutes for sure. I'd like to give people opportunity to.
Oh, okay. So maybe we'll talk about this some other time, but just so you guys are aware, if you click on a scanner, there's a lot of great information in here, but maybe we'd have to have you back on the show and maybe just dive into how to really take this information and put it to use as a trader for an individual investor, right? Who maybe is not totally well-versed in Delta and Gamma and Vanna, but can just look at the chart and say, here's where we should focus. So maybe we'll do that next time. But so for right now, let me just ask you a couple questions. We'll see. We got a couple questions. Let me just read them off. Let me see if there's something I can throw at you. Okay, so one question, it seems the scanner works much better with stocks that have a lot of option volume, and there's more volume. The more volume, the more accurate the spot gamma info. So
100%.
100%. So when we look at the chart here, let's say I'm trying to think of a.
So if you think while you're pulling that up, if you just think about what a big options position is telling you, that there's big hedging flows, and all this boils down to is how much hedging flows is there relative to a stock's daily volume, right? Is that a material amount? Is it a 50% of an average daily volume? Is it 1% of an average daily volume, right? And that's really what matters here in a lot of ways. And there could be an individual strike where everything is positioned, and that hedging flow could be very tied to that strike, right? But if we move far away from that options level, then that hedging flow stops being impactful, right? So it is a dynamic relationship that you need to sort of understand. But at the end of the day, we're talking about volume, right? Is the hedging volume by the dealers so big that it controls or has a major influence on the stock?
Okay, so when we look at this is Canopy Growth, could you explain that for me? Is that just a misprint, or what is that?
Yeah, so we have there's a little funkiness in the model there that needs to be worked out. But basically, there's two things that you're seeing here. One, you have green, a big green area, which is telling you that there's call call dominated. And then two, that line increases as the stock moves higher, which is telling you that volatility in the name actually should, or the impact of options market maker activity should actually help move the stock faster, right? Or move the stock higher. So this is a very bullish setup. And again, I'm not sure where the stock closed, but
the stock was down about 9% today.
Yeah. So we're at what? We're at 33 or 34 or something like that.
Yeah.
Yeah. So what's interesting about this name is 60% of that gamma expires at on Friday. All these pot stocks were down, pretty big actually in general today. So I don't know if there was different news about that out there, but this is sort of the interesting thing about the dynamic of these options where we build very fast gamma, right? We build up very quick options positions, and those options positions are very powerful in helping stocks go up higher, right? But think about the unwind. As soon as that stock starts to reverse, the dealers are selling off all the shares that they bought as a hedge, right? So the CHWY was an example that you brought up before, where the stock, just as fast as that stock went up, it came back down.
Right.
And those cannabis stocks got, obliterated really kind of across the board, even though a lot of them have pretty bullish setups. So,
I got it.
yeah, I mean, I love to be the master of all things on all stocks at all times, but these flows, particularly when they're tied to this week, right? Live by the sword, die by the sword. They create a lot of volatility, and if you're on the right side of that, man, it feels good, right? But if that starts to reverse against you and that call volume dries up, you're going to have that force really slam against you.
I got you. That's interesting. But one of the questions we have is, I don't exactly know how to, let me just throw it out there as a question. And maybe we already covered this, but how do we know when a call wall on a stock, not exactly sure what this subscriber is asking, but it's like a fake call wall. It's not really a call wall. Would that be really just a question of there's not a lot of calls trading, so you don't have to worry about that wall? Or is there
small options volume? And again, I can't just give a blanket answer of what is material, because you have to figure out what is the float on the stock, right? How much does it trade every day? And then, so like 10,000 options in LEVI's might be important, right? But 10,000 options in Apple doesn't mean anything, right? Okay. So you need to adjust some of that. And one of the things that we show on the charts is there's a dark line, right? That that you see that shades the colored area, right? It's a blue line, and that blue line can either be very dark or very light, and that's telling you how much options volume we have related to the stock's average daily volume. So we're actually giving you some weighting, and mentally that's what you want to do, right? If it's a small cap stock, then maybe 5,000 options at a certain strike is material and means something. If it's, again, Apple, it doesn't mean anything. And the other thing that you need to understand is weighting. So what I mean by weighting is, are most of the call trades buying calls being bought by option? Are traders buying calls, or are they selling calls? So if you look at a name like Bank of America, for instance, there's a huge options position, but most of those options are being sold as yield enhancement because people hold Bank of America. And I think this is actually true in Apple and Amazon as well. They hold these stocks. They assume they're never going to go to zero, right? And I'm just going to sell calls every week against it, right? So that darkness there tells you, big option position, right? So, but I think most of that is actually call and put writing, right? Income trades.
This is precisely a question one of our ARMR Insiders, and he happens to be all he does is trade options, and he's real good at it. And one of his questions to you is I think focused right on that you just hit on. How does the scanner know if the calls are being bought or sold? So if there's 10,000 contracts at $30 strike and 8,000 are sold positions instead of bought positions, how does it change this picture at all? Does it?
Yeah. So, this is sort of one of the areas of research that we're working on, right? It's very hard to know whether people are buying or selling options. And that's why I mentioned before, you have to kind of understand the stock and what's going on. And that's what made those retail stocks such an, quote unquote, easy trade to figure out direction, because you knew they were all buying calls in GameStop and buying calls in the cannabis stocks, right? And Bank of America, fundamentally, you know that there can't be that many people thinking that Bank of America is going to go up over $42, right? But if they can sell that call and bring in a yield, then they're keen to do that. So when you then, in your scenario of what might the stock do, you need to mentally adjust for that a little bit. And we're working on some ways to improve that scenario. But the model here assumes that all calls are bought and all puts are bought, which, clearly there's room for improvement there, but you can mentally adjust, the metrics for that.
No, but that's the point though. See, this is the spot gamma information is a source, and we have to use it as traders and investors and apply it to what we're doing. Right. So that's a great point that you just made right there, though. If I've got 50 stocks that I'm following and a handful of them are like Bank of America, that might not be the stock I want to trade that day as it goes above a call wall. Right. I might want to I don't like to trade 50 stocks. Some people do. But the way I like to trade, I don't put on more than 10 trades at most at a time. But I mean, really 5 trades is what I try to do. And I put big positions on. That's how I like to do it. So I'm trying to figure out which ones do I want to focus on, right? Mm-hmm. And you just made a great point. If it's a stock that, all these names that you just mentioned, I could put a trade on there, or I could put a trade on, let's just use CHWY. Let's pretend CHWY had a great looking, green call all the way to, next week. I'm going to focus my money on CHWY because it's a question of reward versus risk.
Right.
The biggest pop going to come from, and it might not be coming from something like Bank of America for that reason.
Right. And that, and to that point too, if you see a big drop in Bank of America and you understand that people are, selling calls and not buying, that can give you a different piece of information that makes you say, okay, now is a great time to buy Bank of America because the force may help bring me back up, some of these dynamic sort of hedging flows. So knowing the name that you're trading and knowing what else somebody's doing is something that you would do regardless of talking about options or not, right? You're not going to trade, Philip Morris on a day that they might ban cigarettes, right? Or maybe you're shorting it. I don't know, but you understand the cannabis stocks. Everyone thinks that legislation is going to go their way. That's one of the big drivers, right? And you need to know that when you're playing in that pool, so to speak. and that's why again I mentioned. If you go to Wall Street Bet site, you can tell these guys are all trying to pump, this stock and pump that stock, and it's a small cap stock. So it's very easy to see, okay, everyone's buying call options. It's obvious. Like I know the weight of the information. Bank of America to me is an obvious one. Other people are selling calls. And then, there's some of these others that aren't necessarily as clear. But you look at like Tesla, for example, where all of those positions line up at 800 strike, and that's where the stock pins day after day, right? And you can see those really big congregated levels show up. Then that can help adjust your weighting mechanism. Maybe I don't need to worry so much that whether people are long calls or short puts or whatever, because everything is so concentrated at 800, all flows eventually, lead to that number, right? All flows eventually lead to that point.
I get it. Here's a question. We might have touched on it, but let's just try to condense the thought here because I'm getting a lot of this question. When we get to a call wall or a put wall, is there one specific piece of information from spot gamma that would let us know, boy, we don't want to, I guess we already went over that.
So let's just talk about the put wall quickly, right? So the put wall is telling you where the biggest net put position is. So how that moves around tells me what hedging activity is like. So if the put wall is at 3,500 today and then jumps up to 3,900 tomorrow, that's giving me a piece of information, right? Why did suddenly this big put position move up? Is that a real hedge? Is that a whole bunch of traders? Is it just one? I'm trying to figure out that information, right? Because did a whole bunch of people just find a reason to hedge is kind of what the question is. The second one is, if you're trading puts, right? Puts are very sensitive to implied volatility. And so you can't sit with put position on the same way that you can with a call position. So if I buy a call and the call's going my way, I might just let the call ride out until expiration, right? Because it's not sensitive to implied volatility. If the stock's going my way, that's cool, right? But if I'm long puts and the stock is tanking, because puts are more sensitive to implied volatility, the price of puts changes drastically, right? I can't afford just to hold those put positions the same way I would a call. So it forces me to roll the position more actively. It forces me to close it at a different time, right? I'm not going to sit and hold that put, the same way that I would sit and hold a call. So my point is that when large put positions, the gamma is highest at the money, right? So if the market meets that put position, that is giving me an indication that whoever owns those puts may want to very quickly or soon would be active in adjusting that position, right? Because when gamma is the highest, when gamma is at the money, you've milked your put position arguably for as much as you're going to get in some ways, right? And so you're going to want to adjust your hedge. And anytime you close a put position, right, especially a big put position, dealers are going to cover their shorts. So that's why that put position becomes an interesting support level. And that's also why the market acts differently when we're surrounded by quote unquote put and put gamma versus call and call gamma, right? Because the market moves differently. It acts differently when puts are in control versus calls, right? Simply on the basis of sensitivity to implied volatility, hedging flows and how active traders are, with those basic positions.
I got you. All right.
What was that? Night has set in here in Connecticut, so.
Here's a good question. What do you think for somebody who's a beginner who's just going to start using spot gamma? They're going to subscribe because it's a phenomenal information source that's really helping us out. What are the first one or two things they should pay attention to? Like all the stuff we're talking about tonight, I love it. It's a master class and we're in it. But for someone just getting started, it's a lot of information. What are the one or two things out of everything that you think they should start with when they start subscribing?
So the basic of the idea, right, is understanding that there is less randomness to the market than it may appear, right? There are these hedging flows which are tied to options which influence stock. And what we talked about before, that those hedging flows are reloadable flows, right? In a way that other flows aren't, meaning that market makers are constantly hedging and adjusting all day, every day. And so if you see where big options positions are concentrating, you know that there's going to be big hedging flows tied to those positions. And a lot of people have a hard time sort of believing that, these hedging flows can be impactful to the market. And so really just trying to understand that dynamic, right? What is delta and what is gamma? They sound, fancy Greek terms, but really all it's telling you is, how much hedging flow there is in the direction of that hedging flow. And if you just sort of focus on that concept as opposed to worrying about pins and expirations and all these things, just understand that these hedging flows, positive gamma, negative gamma, what is that telling me, right? Mean reversion and volatility suppression when we have kind of positive gamma, and negative gamma is directional trading. And if you can kind of just grapple with that concept, I think is really what's key.
No, I'm with you. What I'm saying is let's say someone starts using your let's say an ARMR Insider subscribes, or anybody subscribes, and they decide, okay, I want to start using this. Here are my favorite names. I'm going to throw it up here and start taking a look at it. And they put, I don't know, QS on the screen.
Yep.
Okay. So where should they? It's hard for them to get all of this information. Is there any one or two pieces of information they should really focus on before they look at their own engine and decide what to do?
Yeah. So, there's two levels of support and resistance to me on that chart, right? The first one is where that hedge wall and the gamma strike line up. So forget the labels, right? But those two that's a resistance or support line. And then the key delta strike would be the other big key, support or resistance line. So, on this chart, that's spread out over 10 points. But if I was going to buy the stock, I would try to buy it around 60, or I don't know if it opened over 70, but 70 would be an interesting level to buy, right? And if I was going to short it, I would try to short it at 70, right? Those are support and resistance anyone can understand. And that's what those levels would be telling me.
Brilliant. Okay, brilliant. So a simple way to start is to just look at delta, look at gamma. Now, what happens when delta and gamma line up together? Is that explosive?
That's just telling you that strike has that much more of a concentrated option position, right? So when all the levels line up, that gives you more confidence in the veracity of that level. Like, Tesla, for example, at 800 has been, all the levels are at 800. I'm going to look for mean reversion back into that level. If I was going to try to go long, I would try to wait for a dip in Tesla to buy the mean reversion back into 800? Because when all those options are concentrated, all those option flows are concentrating back to that 800 strike, right? It's a magnet.
Brilliant. So a simple way for somebody new to this game that's just starting to use the information, and I know it's hard to ask you this because it's your baby and everything's important, and I get it.
No.
I mean, that's how. But a simple way to look at it is if you're going to use the equity scanner, the equity hub. Thank you. You're going to use the equity hub. You're going to put your stock in and see, what do I do with this stock? Well, the idea is look at gamma, look at delta. Right? Try to, if it's separated apart, you're buying one and selling the other, or if you're an investor looking to invest, you're looking to buy closer to one. And so, or if you see them tight together, you think to yourself, there's no reason to chase this thing. It's mean reversion.
Right. So like I would not have bought Tesla at 800 thinking that it's going to have a big breakout, right? This week at least.
Right. That's my point. Right.
Right.
That's what I'm saying. So somebody who says, okay, what do I do with Tesla? And so here's the point, right? The hedge wall, the delta, the gamma strike are all tight together. And so this might answer another question when someone says a fake wall. It's not necessarily fake, but what it means is when they're all connected like that and you see a breakout above it, it's probably not going to run away from you.
Right. And again, this all ties back into how big is that options position, relative to the flow in the underlying stock. And so in Tesla, there's big options position. We know that, right? And in some other names, there might only be 100 total contracts. And so you can look and say, okay, there's only 100 options that exist in this name. So the flows there are meaningless, right? They don't mean anything. So that's part of the coloring scheme. The darker the color on those charts, the more it matters. And even if you don't have spot game, if you were to look at your brokerage system, you can pull up an options montage and see what the open interest is at every strike, right? You can look at the volume of every strike and you can see there's a ton of options volume at this strike. There's a huge open interest amount at this strike and tell, okay, this is an important level, right?
Right.
And there's hedges around that.
What do you mean they're not going to have spot gamma? They're definitely.
Look, man, I love to sort of be, promote myself, and I appreciate everything, but I just want people to understand, like, you can do this, without our system. We make it, I think, infinitely easier for you to do it, but this is in some ways it's publicly available. We just do, I think, a very good job of modeling it and distilling it for everybody. But
and I do too, and I think that's a great message to end on tonight. This has been so much fun, Brent. I really appreciate you joining us, and really, quite frankly, look forward to having you back at some point for maybe Masterclass 2.0, with a whole nother list of questions. But I really appreciate your time tonight. Thanks so much for joining us on the ARMR Report.
Great, thanks, Brett. Appreciate it. Thanks, everybody.
Take care, everybody. Have a good night.